While the media was busy telling you about tariffs, trade wars, and a shaky dollar, something extraordinary just happened on the XRP ledger. And almost nobody is talking about it the right way. In under 90 days, the value of tokenized commodities on the XRP ledger went from $111 million to over $1.1 billion. That is a 920% increase. Not in a year, not in a bull cycle, in 3 months. And here is the part that matters. That's not hype. That's not a rumor. That's on-chain data from World Asset Analytics. That is verifiable, traceable, real capital moving onto this network in real time. So the question I want you to sit with for the next 15 minutes is this. If the rails are already being used, if the capital is already flowing, if institutions are already positioning, what exactly are you waiting for? Pull up a chair. Let's break this down properly. Welcome back. This channel exists for one reason, to cut through the noise and give you the analysis that the mainstream won't. No hype, no moon boy fantasy, just data, logic, and pattern recognition. Today we're looking at 4 converging signals that are reshaping how global capital moves, and XRP is sitting at the center of every single one of them. Let's get into it. Let me start with the hard truth. Most people watching XRP are watching the wrong thing. They are watching the price chart. They are watching the weekly candle. They are refreshing their portfolio and asking, why hasn't it moved yet? And here is the answer that nobody gives them clearly enough. Price follows infrastructure. Always, without exception. Think about the early internet. The fiber optic cables were being laid underground for years before a single consumer touched a browser. The telecoms, the backbone providers, the routing infrastructure, all of it was being quietly assembled while the average person had no idea it was happening. Then one day, the internet existed and it moved fast. That is exactly what is happening with the XRP ledger right now, and I can prove it with numbers. The XRP ledger just crossed a milestone that almost no one covered correctly. It now holds over $1.14 billion in tokenized commodities. That makes it the #2 blockchain globally for tokenized commodity assets, behind only Ethereum, ahead of Polygon, ahead of Solana, ahead of Arbitrum, and ahead of BNB Chain. But here's what matters beyond the ranking. 15% of every tokenized commodity on any blockchain in the world right now lives on the XRP ledger. One network. 15 cents of every dollar of tokenized commodity value on the entire planet. Now here is the hidden mechanism most people are missing when they read that headline. Tokenized commodities are not retail products. Nobody's grandmother's buying tokenized oil barrels on her phone. These are institutional instruments. Sovereign wealth funds, treasury desks, energy trading firms. When that capital moves onto a blockchain, it brings with it a requirement, a non-negotiable infrastructure-level requirement for a fast, cheap, legally clear settlement asset. And that is not a wish, that is a design requirement. The XRP ledger was built for exactly this. 3 to 5 second settlement, fractions of a cent per transaction. ISO 2022 compliant. And now, for the first time in its history, it has regulatory clarity in the United States following the SEC resolution and expanding clarity across Europe with MiCA, across Japan through the FSA framework, and across the Gulf through fintech licensing in the UAE and Bahrain. The pipes are laid. The water is starting to flow. The question is whether you understood what the pipes were for before the pressure came on. Let's do the math. And I mean real math, not moonboy math. The cross-border payments market processes roughly $150 trillion per year, every year. That is not a future projection. That is the current size of the market today, using SWIFT, correspondent banking, and Nostro Vostro accounts that have $27 trillion sitting locked in pre-funded positions, doing nothing but serving as collateral for slow, expensive, outdated rails. Now here's what I want you to think about. You don't need XRP to capture that entire market. You don't need 50%. You don't even need 10%. If XRP's on-demand liquidity infrastructure captures just 1% of that annual cross-border flow, 1%, you are talking about $1.5 trillion in annual transaction volume flowing through the XRP ledger. At current prices and current circulating supply of approximately 57 billion tokens, that volume demands a settlement asset capable of absorbing that throughput without catastrophic slippage. At the current price, the math starts to strain. The network needs price to rise, not as a speculative outcome, but as a functional requirement to handle the liquidity load efficiently. This isn't a prediction. And now, layer on top of that what we just learned from World Asset Analytics. $1.14 billion in tokenized commodities already sitting on the ledger. The tokenization of real-world assets is projected to reach $4 trillion by 2030, according to multiple institutional research arms. If XRPL maintains even its current 15% market share of that wave, you are looking at $600 billion in tokenized assets settling on this network. Think about that math. Fixed supply of 100 billion tokens, approximately 57 billion circulating, a meaningful portion locked in escrow, most of which gets relocked each month. Exchange reserves at multi-year lows, according to CryptoQuant data, with the scarcity index recently flipping to positive 0.48, meaning there is now less XRP sitting on exchanges than the historical average. Supply is quietly leaving the market. Demand from institutional use cases is quietly arriving. Those two lines are moving toward each other, and when they cross, a math stops being theoretical. Now let's talk about who is actually moving on this, because this is where the retail crowd consistently gets it wrong. Retail investors watch price. Institutional actors watch positioning windows. And the positioning window for XRP is quietly closing, not because the price is running away from them, but because the regulatory and infrastructure prerequisites they required are now being checked off one by one. Start with Goldman Sachs. At the close of 2025, Goldman disclosed $150 million in XRP ETF exposure. Goldman Sachs does not take a $150 million position in a speculative lottery ticket. Goldman Sachs takes a $150 million position when their legal team, their compliance department, and their risk management desk have all signed off. That is not FOMO. That is calculated institutional positioning. Combined ETF inflows into XRP investment products crossed $1 billion in the second half of 2025 alone. Those are not retail dollars. That is institutional and high net worth capital entering through compliant, regulated vehicles, exactly the on-ramp that smart money prefers. Now, look at what Ripple itself is doing operationally. Brad Garlinghouse and Monica Long just completed a sprint across 4 offices on 3 continents in 5 days: Dublin, London, Singapore, Sydney. They are not doing this to generate headlines. They are doing this to accelerate the embedding of Ripple infrastructure into institutional payment, custody, and treasury management workflows. They are embedding AI-powered real-time cash flow forecasting into the stack. They are building CFO-grade liquidity tools on top of the XRP ledger. Ask yourself this brutal question. Does a company building for a bull run fly across 3 continents in 5 days to meet with banks and custodians and payment processors? Or does a company building permanent financial infrastructure do that? The answer should be obvious. And then there is Evernorth, the company preparing to list on NASDAQ under the ticker XRP as what they are calling the largest publicly traded XRP treasury company. Their stated model: acquire XRP and deploy it within the XRP ecosystem. This is the Michael Saylor Bitcoin playbook being applied directly to XRP, but with one key difference. XRP has utility. It settles transactions. It bridges currencies. It generates yield through liquidity provision. This is not just a Treasury reserve play. This is a productive asset accumulation strategy. These are not retail investors taking screenshots. These are entities building business models around XRP's continued expansion. Now let's talk about what is coming, because the timeline is tighter than most people realize. First, the Digital Asset Clarity Act. This legislation is moving through Congress, and if signed into law, it does something no executive order or court ruling could fully accomplish. It creates statutory clarity for the entire digital asset industry. That means every financial institution sitting on the sidelines, waiting for a legal green light, gets that green light simultaneously. The capital that enters when that moment arrives is not retail capital chasing a pump. It is institutional capital that has been pre-positioned, pre-approved, and preloaded. Second, Japan's XRPL event in April. Evernorth's leadership will be on the ground. Japan's FSA has been one of the most progressive regulatory bodies for digital assets anywhere in the world. The partnerships being built in that corridor between Japanese financial institutions, XRPL infrastructure, and tokenization projects are not being covered by Western media. That is not a coincidence. That is an arbitrage opportunity for the people paying attention. Third, the macro environment itself. As global trade continues to fracture along multipolar lines, with energy exporters increasingly invoicing in non-dollar currencies and BRICS nations pushing de-dollarization, the need for a neutral bridge asset that no government controls is not shrinking. It is growing. And XRP is the only asset that is both technically capable of filling that role and has a decade of institutional relationship building behind it. The conditions are converging. Here is what the chart does not show you. Supply on exchanges is at a multi-year low. The scarcity index has flipped positive. Coins are moving into private wallets and institutional custody. That is not a retail behavior. Retail panic sells into red candles. What we are seeing is the opposite. Quiet, steady, patient accumulation by entities that have no interest in broadcasting their moves. The window that exists right now between infrastructure being built and price reflecting that infrastructure is the window that creates generational opportunity. It is also the window that closes without announcement. The question is not whether this is happening. The data says it is. The question is whether you are positioned before the math becomes undeniable to everyone else. Let me bring this full circle. In 3 months, tokenized commodity value on the XRP ledger grew 920%. Goldman disclosed $150 million in ETF exposure. Evernorth is preparing a NASDAQ listing as an XRP treasury company. Brad Garlinghouse is on 3 continents in 5 days, embedding Ripple into the backbone of institutional finance. Exchange reserves are draining. The scarcity index has flipped. None of these are rumors. None of these are hopium. Every single one is a verifiable, documented, on-chain or publicly filed data point. The retail crowd is watching the daily candle and asking why XRP hasn't gone parabolic yet. The institutional actors are quietly checking the last boxes on their compliance list before they move capital at a scale that retail cannot comprehend. One group is watching the noise. The other is watching the structure. You know which one you are because you made it to the end of this video. This is not financial advice. Do your own research. Understand your own risk tolerance. But do not let anyone tell you there is nothing happening here, because the data says otherwise, and the data does not lie. If this kind of analysis is what you come here for, drop a comment below and let me know what catalyst you are watching most closely. I want to see who in this community is actually paying attention. Subscribe if you haven't. We do this every day. I'll see you in the next one. Stay rational, stay patient, stay positioned.